Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, Senior Investment Analyst. So happy to have Zach on board here for this week's Market Carver. I was just thinking as I was clicking on here that one of the things that Zach and I have in common, besides a passion for this industry, is a passion for sports. And it's pretty much every time we have a lunch or something where we can get together and chat personally, it always inevitably winds up on sports or something of the like, Zach. So I think that's you also have one of the great fantasy football names of all time, I think, using your last name and the Unger Games.
Yeah. Fantasy football team name is the Unger Dogs. I've recently gotten into baseball as well, which has been a lot of fun. A lifelong football fan, but the data that is in baseball, the ability to break down and analyze players and teams and how they're performing, pretty similar to financial markets, believe it or not.
Yeah, I do believe it, and I read a lot about baseball, and you find so many parallels in the way that we look at things objectively and data analysis and building a team and building a portfolio. So I just want to get people to get to know you like I know you, and especially for the sports lovers out there. But that's sports. As we pivot to finance, we've got three topics to cover for you this week. We're going to take a look at an updated rate cut outlook. Zach will unpack that. I will then look at what it fueled in terms of a small cap rally, and then Zach will bring us home, looking at the impact of valuation from market trends this year. So Zach, why don't you kick us off and let us hear what you're seeing in terms of the rate outlook market?
Yeah, so if you were with us last week, you heard our discussion on unemployment rate and how that's slowly ticking up a little bit, and how that piece of data combined with a handful of other pieces of data could influence the Fed's decision in their upcoming meetings in July, but namely in September. We did get some of that core, the key data rather. Inflation in the form of CPI was released last week. On a year-over-year basis, we continue to see that dropping, and on a month-over-month basis, actually saw the first outright decline in inflation since the end of 2020, October of 2020. So all that together kind of points towards the Fed being relatively successful in their endeavor to moderate inflation. A reminder that we will get PCE at the end of next week, PCE being the Fed's preferred measure of inflation. And all of this is going to come together and should provide or set the table for what the Fed will decide in the upcoming meetings. So the chart that you're seeing on the screen here is the market's projection of where that Fed rate will be for the September meeting. So remember that the July meeting coming up here in a few weeks, the September one being the one to follow. And you can see that the big bar in the middle, the market projecting a 90% chance that we see our first 25 basis point cut in September. Over on the left-hand side there, you can see a small fraction of the market projecting a slightly larger cut or maybe multiple cuts. But really what we're going to be looking for going forward, the PCE data, as I commented on, as there's no doubt that will play a large role in the Fed's decision. We'll also be monitoring the July meeting coming up here in a couple of weeks, as we expect that the Fed will start to lay the groundwork for where they're going in September. As we talked about last week, certainly will influence the fixed income markets, and we'll be keeping an eye on all of that stuff as it rolls out. We'll go over to Adam now for some small cap talk.
Yeah, well done, Zach. And that's very clearly, you can see it on the chart here and the exact timing of the CPI release and the market impact. That's going to be the panel there with the black chart. The orange line there is the Russell 2000, the most well-known index for small companies. And then the blue is the NASDAQ. And you can see them going in very clearly different directions and very quickly. Small caps had a big boom after this rate cut. Generally, rate cuts are thought of as being bullish for equity markets, and especially on the small capitalization side. Meanwhile, the NASDAQ, so many of those companies that have driven the market, took a step back as people kind of rotated from the area that has been stronger to one where they think would be stronger if we see rate cuts enact. And that happened, like I said, very, very quickly. 3 minutes got the majority of the gains there between 8:30 and 8:33 as the computers really picked up the buy signal. One question we get a lot is, why are the rate cuts more advantageous for small caps than others? First, I would say there's generally this element of being a stronger beta, meaning there's more of a market sensitivity. So when the market goes up, naturally with small caps having more sensitivity, they go up more. But in this specific unique environment, we're at a place that if you're at the 30, the chart on the right panel may look familiar. This is the trend of companies inside that Russell 2000 over time who have become unprofitable. A whopping 40% of the index right now is unprofitable. And that is chiefly because they have an interest expense that's larger than their operating earnings. And so if you begin to back off and reduce interest, so many more smaller companies now, rather than being cash rich, like your Google and Microsoft and Apple, which have hundreds of billions, if not trillions in cash, we have here on the small company side where there's a bigger nature of debt. And so interest rates coming down are presumed to have an outsized impact on small caps. And that's really why I think you saw the small caps jump right out of the gate. Whether or not it continues, I think we'll have to take somewhere between now and the next couple of months a moment of pause and ask what 25 or 50 basis points would really do for this rally and whether or not it's more of a relief rally. But that'll be specifically what we're watching here, whether it's trend or just a little bit of catch up. So that's small caps. And then Zach, you can bring us home with the relative valuation chart.
Yeah, so what we're looking at here, this chart is measuring the premium price to earnings ratio relative to that of an S&P 500 equal weight index. Sounds complex, so we'll break down some of the nuances and then talk about implications. S&P 500 equal weight simply takes the S&P 500 and rather than weighting it by size of the company, distributes the weight equally across all of the index participants. The price to earnings ratio is a very common valuation tool that's used by analysts like myself. Essentially, all it tells us is the price that we're paying, stock price, per dollar of earnings. So, for example, if your stock price is $20 and on a per share basis, the company is earning $1, your price to earnings ratio would be 20. This chart then is taking the mega cap tech stocks, the top 50, their price to earnings ratio, which you can see up in the top left-hand corner there, that 32.3. And then it takes the price to earnings ratio of the S&P 500 equal weight index, 17.6. And it says, what's the premium? What's the additional price that you have to pay for the earnings on a dollar of earnings for a mega cap tech stock relative to that of the equal weight 500 index? And so you can see as that line drifts higher, what it's telling us is that we are paying a larger and larger premium per dollar of earnings for a tech stock, a mega cap tech stock, than we are for the S&P 500 equal weight. Implications for this, it's to be expected because these tech stocks are growing quicker than an average company. It's to be expected that the price to earnings multiple would be a bit higher for them. But you can see now that we've gotten close to double the price to earnings. It's become pretty extended. And so we would expect to see either that premium drop a bit, the premium to moderate over time. And that could really happen one of two ways. Either we see the rest of the market catch up to that price to earnings multiple, like we're seeing a little bit right now, or we could see some concentrated softness in those mega cap tech stocks. The main implication for us in portfolio management and for you to make sure that we're taking care of your money is to properly diversify. It would be easy to say, let's go chase the returns of a mega cap tech stock. They're running wild. We've talked about how they've been leading the market. But really, if we do see some concentrated softness in that area, it exposes us to downside that we don't want to be exposed to. So we're continuing to maintain proper diversification across the portfolio, which also keeps us from paying that high premium.
Yeah, that's very well said. And I would say it's one of those things that's just easier said than done, right? When you begin to have this runaway freight train, very difficult not to put more of your chips into that. But I think that's just further evidence, that chart, of why we must be diligent. So thank you, Zach, for jumping on board. And we'll look forward to getting this All-Star week behind us so we can resume the regularly scheduled games here and get the second half of baseball underway. And thank you to all of you for giving us a few minutes of your time. As always, we'll leave you with a reminder. If we can be of service, please give us a call, 800-928-4001, or scan the QR code and book it electronically. As always, thanks and have a great weekend.